Hey, in today's video, we're going to be talking about FHA loans, the good and the bad. So what are FHA loans? FHA loans are mortgages backed by the Federal Housing Administration, or FHA. They have distinct requirements compared to other types of home loans. FHA loans have easier qualifications, making them accessible to individuals with less than perfect credit or a history of bankruptcy, which is kind of not smart if you ask me. If you have credit issues and you can't pay your bills, a bigger debt is definitely not the answer. Anyway, one misconception is that you don't have to be a first-time home buyer to be eligible for an FHA loan. However, they are particularly favored by first-time home buyers due to their combination of low down payment requirements and more forgiving credit score and debt standards. While some conventional mortgages may allow down payments as low as 3%, qualifying for them are usually harder. They have stricter credit score and debt-to-income ratio criteria than minimums set by the FHA. FHA loans are not directly provided by the government. Instead, the FHA insures them on behalf of lenders such as banks and credit unions. Now, these would be your local banks or big banks such as Wells Fargo and BofA, etc. While the government establishes a minimum requirement or minimum requirements for FHA borrowers, each lender has autonomy to set its own criteria, which can include a higher credit score. This is also known as an overlay. Because lenders can have varying qualifications, it's beneficial to shop around and compare different FHA lenders. This way, you can assess their interest rates, fees, and specific requirements, allowing you to make an informed decision that best suits your financial situation and needs. In other words, you might not qualify for an FHA loan with, say, BofA, for example, where they have a minimum credit score requirement of 620. But if you go to a mortgage broker, they may be able to find you another FHA lender that can get you approved. Here are the general requirements of an FHA loan. Again, let me remind you that each lender have different requirements, so it's essential to shop around, compare different lenders, and find the best terms and options that suit your needs. The FHA minimum credit score. Borrowers can qualify for FHA loans with lower credit scores than most conventional loans allow. You can have credit scores as low as 500 to qualify for an FHA loan. That's mind-blowing to me. FHA minimum down payment. The required down payment for an FHA loan depends on your credit score. If your credit score is 580 or higher, the minimum down payment is 3.5%. For credit scores between 500 and 579, the minimum down payment increases to 10%. This is also known as the minimum required investment, or MRI, fancy term for down payment. FHA debt-to-income ratio. All lenders consider your debt-to-income ratio regardless of the mortgage type. A lower DTI indicates better affordability and repayment capacity, meaning you don't have a big amount of debt. The FHA guidelines for DTI varies based on your credit score and other financial aspects like available cash reserves. There are two ratios the FHA looks at: the PTI, also known as the front-end ratio, and DTI, also known as the back-end ratio. I won't bore you with the explanation about this. Moving on to FHA loan income requirements. FHA loan income requirements are flexible and not tied to a specific salary requirement, meaning technically there are no minimum salary requirement as long as you qualify. However, to qualify for an FHA insured mortgage, you must meet the following criteria. Show 2-year income history. Provide proof of an income history for at least 2 years, which can be verified through employment records or documentation of enrollment in a school or the military. Establish credit history. Most commonly, this is done through the traditional credit score. However, if you lack credit score, you can demonstrate a history of on-time payments for at least 3 types of bills, such as rent or utilities. No delinquent federal debt or judgments. Ensure that you do not have any outstanding federal debt or judgment, whether related to taxes or other matters, or any debt associated with past FHA-insured mortgages. Accounting for cash gifts. If you receive cash gifts to assist with down payment, they must be properly documented and verified. These gifts can come from various sources, including friends, family, charities, employers, or unions or government agencies. The gifts must be provided in writing, signed and dated by the donor. Don't just take cash. Let's talk about FHA loan limits. The range for the FHA loan limits are from $472 to $1,089,000. These limits are determined by county and can vary significantly. The loan limit of $472 is considered in low-cost areas and $1,089,000 in high-cost areas such as the Bay Area. Certain counties may have limits that fall between these amounts. For precise information on FHA loan limits in any specific county, you can easily access those at the HUD website. And I'll link to that website below. To apply for an FHA loan, you'll need the following documentation: a valid government-issued ID like a driver's license or a passport, proof of your social security number, 2 years worth of original pay stubs, W-2 forms or valid tax returns, signed and dated letters specifying the source and amount of any gift funds, clearly stating that the money is not repayable. Again, don't just take cash. An FHA approved lender will guide you through any additional documentation requirements specific to your situation during the application process. Let's talk about FHA properties, or the property that you're looking for. To qualify for an FHA mortgage, the property you wish to purchase must also meet specific criteria in addition to your borrower qualifications. It has to be a principal residence. The loan must be for your primary residence and not a vacation or second home. It also has to meet occupancy. At least one borrower must move into the property within 60 days of closing and intend to occupy it for at least 1 year. Property types: eligible properties include single-family homes, detached or condos or townhomes, multifamily homes with up to 4 units. You must occupy one of the units, or a manufactured home on a permanent foundation. Technically, investment properties are not allowed, with the exception, like I said earlier, multi-unit, 4-unit multifamily dwelling where you live in one of the units. Appraisal: the property must pass an FHA appraisal, ensuring it meets FHA's minimum property standards. House flipping: FHA does not allow purchasing a home within 90 days of prior sale. These are going to be your flip houses, meaning if I buy a house right now and I remodel it, and then in 30 days I sell it, most likely, well, not most likely, FHA will not fund those loans. There are certain exceptions to this. Like, for example, if I inherited a home, so that title transfers, like let's say today, in 30 days from now, I can sell it. In terms of title, you must take title to the property in your name or in the name of a living trust at settlement or closing. FHA mortgage insurance requirements: there are 2 mortgage insurance, one upfront and 1 monthly payments. FHA loans are appealing to lenders because they're insured by the FHA, providing a safety net in case of foreclosure. As the homeowner or borrower, you fund this insurance through the FHA mortgage insurance. The first one is upfront payment. You'll need to pay an upfront mortgage insurance premium equal to 1.75% of the loan amount at closing, which can be rolled into your loan, meaning you can finance that or pay it as part of your closing costs. Following that, you'll also make monthly mortgage insurance payments. If your down payment is 10% or more, you'll pay monthly mortgage insurance for 11 years. If your down payment is less than 10%, you'll continue to pay mortgage insurance for the life of the loan. The insurance amount is based on your mortgage length, total cost, and total down payment. Unlike private mortgage insurance, FHA mortgage insurance can't be canceled once you reach the 20% home equity. However, you could refinance into a conventional loan to remove the FHA mortgage insurance requirement once you have sufficient equity. This process involves getting a new loan, paying for additional closing costs. If you've had foreclosure happen, you'll need to wait 3 years before applying for an FHA loan. There are certain exceptions like serious illness that may be considered. For bankruptcy, you typically need to wait 2 years after a Chapter 7 bankruptcy and at least a year after a Chapter 11 bankruptcy to apply for an FHA mortgage. FHA loans are attractive to borrowers with lower credit scores or smaller down payments due to their more relaxed qualification requirements compared to conventional mortgages. These loans can be helpful for first-time home buyers facing credit and down payment challenges. Also, as a first-time home buyer, you have the potential to combine an FHA loan with down payment assistance or closing cost assistance from state first-time home buyer programs or city programs or any, charitable institution. These programs can be valuable in making home ownership more accessible, as FHA permits gift funds to cover these expenses. Utilizing such assistance programs could make affording a home a more comfortable possibility for you. However, it's important to note that anyone, whether a repeat buyer or a current homeowner seeking to refinance a mortgage, can use an FHA loan as long as they meet the eligibility requirements. Now that I've gotten your hopes up, let me tell you why FHA loans are not good in the Bay Area. FHA loans are not as attractive in the Bay Area and other high-cost housing markets for several reasons. The first one, loan limits. Loan limits. FHA loan limits are set by the county and can be lower in high-cost areas. In the Bay Area here, where home prices are often significantly higher than the national average, the FHA loan limits may not be sufficient to cover the cost of many properties. Borrowers looking to purchase more expensive homes might find that the loan amount offered by FHA is not enough to meet their needs. There is a way around this, and that is by making up the difference between the loan amount and whatever shortage that you need. For example, for whatever reason, you cannot qualify for a conventional loan but could qualify for an FHA loan. You can bridge that gap, or you can make that difference between the purchase price and the loan amount in the form of more down payment or additional down payment. That is, of course, provided that you have the funds to do so. As I mentioned earlier, FHA loans require borrowers to pay mortgage insurance premiums. These premiums can add significantly to monthly mortgage payment and may be higher in higher cost areas. In the Bay Area, where home prices are already elevated, the additional costs of mortgage insurance premiums can make the overall loan more expensive compared to conventional loans. We have a very competitive housing market here. The Bay Area is known for its highly competitive real estate market. Sellers often receive multiple offers, and many sellers prefer buyers with conventional financing over FHA loans. Conventional loans generally have fewer restrictions and may be perceived less risky than FHA loans, which can put FHA borrowers at a disadvantage in a bidding war. And if you're wondering if it makes a difference at the end to the seller whether it's a cash or conventional loan or an FHA loan, the answer is no. It's the perceived risk that is attached to FHA loan that gets you. Property condition requirements. FHA loans have specific property condition standards that must be met, as I mentioned earlier. In some cases, properties in the Bay Area may have issues or deficiencies that do not meet FHA guidelines, making it more challenging for FHA borrowers to find suitable homes. Appraisal issues. FHA appraisals have stricter guidelines than conventional appraisals. If an FHA appraiser identifies any property deficiencies such as safety hazards or needed repairs, the seller may be required to address them before the loan can be approved. This could potentially complicate the purchase process and delay closing. And having the seller make repairs here in the Bay Area probably have a better chance of winning the lottery. Certain restrictions I think I mentioned earlier regarding HOA. If you're buying a condo or a townhome, the HOA, the association, the homeowners association, has to be approved with the FHA. It has to meet certain criteria, and primarily it has to do with financing and funds within the HOA. Now that's still separate from the actual property, the actual condo meeting FHA guidelines. Despite these potential drawbacks, FHA loans can still be a viable option for some home buyers here in the Bay Area, especially for those with lower down payment savings or lower credit scores in less competitive neighborhoods. However, it's crucial to consider specific housing market conditions, loan limits, and potential costs involving before deciding, on an FHA loan or exploring other mortgage options that may better suit individual circumstances. Consult a lender, a mortgage advisor. They can help you determine the best financing approach based on your financial situation and current real estate market dynamics here in the Bay Area. I can help as well, by the way. FHA loans plus down payment assistance equals false hope most of the time here in the Bay Area. Thanks for watching.